And joining us now on the debate in Berkeley, California, Brad DeLong. He is professor of economics at the University of California, Berkeley. In Washington, D.C., Tim Kaine, economist at the Kauffman Foundation. In New York, Jeff Madrick, author of The Case for Big Government. And here in studio, Don Drummond, chief economist with the TD Bank Financial Group. And as I welcome all of you, both Don here in the studio and in Points Beyond of the program tonight, let me start by reading something the New York Times reported a few months ago, written by Gregory Mankiw. It goes like this. If you were going to turn to only one economist to understand the problems facing the economy, there is little doubt that the economist would be John Maynard Keynes. Although Keynes died more than half a century ago, his diagnosis of recessions and depressions remains the foundation of modern macroeconomics. So Don, start us off. Why so long after this man's death is his name still on everybody's lips in the middle of an economic downturn?
Well, as often in economics, you're looking for parallels in history. There's a big unknown out there, and you're trying to see, was there a similar experience in the past? And of course, we race through the experience of Japan in the 1990s, but they really messed it up in the policy, so we don't really find the parallels. And without putting a curse on anything, people are starting to raise the context of the Great Depression. There's certainly parallels in what we've seen in the United States. And of course, while Keynes made many valuable contributions to economics, his seminal piece was The General Theory, written in 1935 and published in 1936, drawing upon his wealth of experience and understanding of what was going on in the Great Depression. So in that sense, it's natural as we draw the parallels of what we see right now to the early 1930s. Let's look at what that man, what the lessons were he drew.
Brad DeLong, why don't you follow up on that? For those who don't know, what was the chief philosophy of economics, if you like, that he was advocating?
Well, he was advocating substantial but targeted and precise government interventions in the economy to try to keep employment and production stable whenever businessmen and banks got extraordinarily depressed or extraordinarily cowardly. You know, I suppose basically I would have said I was more a monetarist than a Keynesian 5 years ago. I'd have said that Milton Friedman, by and large, won his debates against Keynes's students in the 1960s and 1970s, and that he convinced people that government shouldn't be too ambitious and that you should aim for rough price stability first, and that trying to manage the economy should be primarily the business of the central bank rather than of the rest of the government through a big spending program, except in emergencies. But right now, we find ourselves in an emergency in which, once again, it's a Keynesian moment.
Let me follow up on that by reading this from Michael Hirsch's piece in Newsweek the past week. After 2 weeks of debate in Washington, he writes, over the stimulus, we now know we have 100 economists in the U.S. Senate and 435 in the House. Not to mention the great economic minds that all of a sudden, it seems, constitute most of the punditocracy and the blogosphere. Some of these people, most I would say, are pretty certain some sort of stimulus is necessary. Others are convinced that a Keynesian approach to government intervention is just the latest version of voodoo economics. Some actually believe it will lead to a catastrophe worse than the one we're in. The question is, what is the truth? Okay, Jeff Madrick, you want to pick up on that? What is the truth?
Well, the truth is we need the stimulus right now. I think the best way to put it in perspective is there's a sudden rushing out of demand for goods and services going on right now. Consumers are scared. Individual Americans are scared. They're scared of losing their jobs. They're scared of their wages going down. They are losing their houses. Businesses are going under. The businesses they work for, the managers of the businesses they work for are scared. They are spending less. They are saving more. As you know, many Americans borrowed more than they made, and on average, our savings rate went down to almost zero. Occasionally, it did go to zero and even negative. If it goes back only to 5%, which is where it was in the late 1990s, that'll be a rush out of the goods and services markets of $750 billion suddenly, and probably more than that. There is a kind of what people call a negative feedback after that. When that money rushes out, businesses lose even more. More workers are fired. Less capital spending goes on. And we don't know where the bottom of that is. That's the nature of severe recessions. That's why everybody is so nervous right now. Let's get a floor under this economy. by getting the government in there to spend money in the most effective way, that's Keynesianism.
Okay, that's the truth according to Jeff Madrick. What's the truth according to Tim Kaine?
Yeah, I think I agree with a lot of what I've heard, but I think also we have a luxury to have this conversation whether we're Keynesians or not, especially here in America, because the rest of the world's throwing their money at our treasury bills right now. But that's the danger. If the U.S. government spends $1 trillion for a stimulus and $2 trillion to save the banking system, who pays for that? In the short term, we hope the rest of the world will lend us that money, but in the long term, this bill comes due. And Keynes wasn't really good about thinking long-term issues. He said, in the long run, we're all dead, famous line from him. But I think one of the reasons that he was discredited, or I should say his movement, because we don't really know what John Keynes would say today.
Now that, in the long run, you're all dead lines out of context.
Okay,
regardless,
hang on a second. Brad, hang on a second.
He wasn't saying ignore the long run. He was saying it's not enough to carry out a long-run analysis.
Go ahead, Tim.
Brad, I'm not going to disagree with you, Brad. I think the point is
the reason
Keynesianism as a movement got right. The reason that Keynes got discredited, that Brad was alluding to, and that Milton Friedman was redeemed, was there was stagflation in the 70s. This notion that you could grow through Keynesianism wasn't right. Stabilization maybe, growth no. You have to look to technology and entrepreneurship for long-term growth.
Brad, you want to come back at that?
Yeah, stagflation's not a problem now. When stagflation becomes a problem, I'll be much more of a monetarist than I am now. But at the moment, if you ask, should we worry about stagflation? Well, I think back in the 1930s, one of Keynes's intellectual opponents said that worrying about inflation back then was like crying, "Fire, fire," in Noah's flood. That it simply, to raise the specter of stagflation is misleading and unhelpful, as is kind of misrepresenting what Keynes said. Right? It's a sign that you don't have any good arguments if you resort to bad arguments that take quotes way out of context as the first thing out of your mouth.
Okay, Jeff, you wanted to get in there a second ago.
Well, I wanted to amend this a little bit. I'm not as much a fan of Milton Friedman's as Brad. I think stagflation was not literally in the 70s a consequence only of money. There were lots of institutional issues then. But we shouldn't argue about that because, as Brad correctly says, that's not the current environment. But what's important to understand in paying down this debt over time is that the economy doesn't sink further. By keeping it from sinking further, we are enabling ourselves to grow out of this problem over time. You know, there are lots of penalties that the economy takes when there are deep short-term drops in economic activity. We invest less, we spend less on R&D, we spend less in human capital, and we reduce, in my view anyway, and this is not specifically a Keynesian view, though I think you'd be sympathetic with it, we reduce the long-term potential of that economy. It's important now to save this economy in part to keep the long-term potential, and I'm emphasizing the long-term potential in light of the previous remarks, to keep the long-term potential strong in order to generate future savings, out of which will pay off some of this financing.
Okay, Don Drummond, take a look at the monitor here in the studio because I'm going to put two graphs up right now, and for you gentlemen out of town who can't see these, I will talk us through them so you can know what we're talking about here, and then Don, I'll ask you a question coming out of this. This first graph is about U.S. government spending 1933 to 1939, essentially the New Deal. And you can see we start in 33 with an expenditure of less than $4 billion, and by the time World War II starts, in 1939, the U.S. government's upwards of $8 billion. Now flip to the next chart and we'll see what the next line does. U.S. unemployment in the same period of time, 33 to 39, starts in the worst of the Depression at 24.9%. We're obviously nowhere close to that today, thankfully. Dips down as the government spends, so we're about 1937 to 14.3%, but then shoots back up to 17.9% by the time World War II begins. So Don, the question is, what empirical evidence is there that large-scale Keynesian government spending, if you like, during times of recession actually improves economic outcomes?
I think there's little doubt from those charts you showed and from prior experience that over a short-term period it does. If you inject money, it will get the economy going. Of course, if we'd gone back a little bit earlier, we should have looked at the antithesis of all of this, complete failure of policy from 1929 to 1933, which is one of the reasons why the post-experience looks good. I mean, the U.S. Federal Reserve Board allowed the monetary base to collapse by 1/3. We initially had a tightening of fiscal policy, and around the world we had a tightening of protectionist policy. So definitely the policy element did get better, but in part it was just because it was so messed up before.
Tim, when you hear those numbers, what do you say?
38.
Right. I think there's a good point. And I would like to say, first of all, there's no real disagreement that Keynes was right about a lot of things. We're sort of debating Isaac Newton here, but the field of economics has moved on a bit, so we're a lot better at some of these things. The notion, though, that Keynesianism is all about government spending, there are different ways to stimulate the economy. I think the Federal Reserve doing stimulus through monetary policy is an important policy that we all agree they need to do, and I think Ben Bernanke's really been aggressive at correcting the approach that the Federal Reserve took back after 1929. You can also cut taxes as a way to stimulate. So I would say a lot of us would agree that there are smart Keynesian policies and there are dumb Keynesian policies, and just building roads or building bridges or long-term infrastructure projects that take a long time to get spent, that'll take us right back to what Japan did, where they have a ton of infrastructure that nobody uses. That's dumb Keynesianism, and I think we've learned a lot of the lessons with the Keynesianism that was maybe practiced during the Great Depression, which I think history shows didn't work.
So Brad, let me get you to comment on this, which I suspect most people would say was
well,
a smart
the
Keynesian.
37,
Hang on a sec, hang on. Let me put the
incident-
question to you first. Hang on. We have a lot of Keynesian programs already today, built into the economy, unemployment insurance, for example, that they didn't have back then. So do we need to be spending? Do we need to be doing as much pump priming, if you like, or Keynesian spending today, given that we already have a lot of those programs in place?
Well, we've undone a lot of the programs because in the United States, state-level budget situations have become sufficiently dire that the state governments are now busily cutting their own spending as fast as they can in order to meet their own budgetary requirements. That the line is we have 50 little Herbert Hoovers, all of them trying to balance their budgets at the state level, just at the time when we'd want them, right, to be increasing their spending to put some of the unemployed people back to work. This 37-38 episode's quite interesting because it shows what happens if you reverse course in the middle. That is, Roosevelt had been beaten up for 4 years for following policies that were too loose on the monetary side and ran deficits that were too big. So in 1937, he decides that he's going to allow the Federal Reserve to sop up excess reserves in the banking system and to try to move toward a balanced budget. And that's when the economy has its hiccup and goes from 14 to, I think, 18% unemployment. That the fact that unemployment went back up in 37 and 38 isn't evidence that the kind of Keynesian programs didn't work in the Depression. It's evidence that they were working and that a sudden reversal of them did quite a lot of damage remarkably quickly.
Jeff Madrick, you want a word on that?
Yeah, I'm glad Brad brought that up. I think it's important to understand that the 1930s were not some uniform application of Keynesianism by any means, and of course the Federal Reserve wasn't that helpful during that period. Also, the budget deficit, I think, and I should have looked the numbers up, I don't think the budget deficit ever got much above 5% of GDP, and that severely depressed economy when production was significantly lower than it was in the late 1920s. We needed much more stimulus than that, and of course we got it. Unfortunately, it required the war to get it.
Don, there has been a great deal of debate in the United States, and even some references to it on our program already today, about the right kind of Keynesian stimulation, be it through program spending, be it through tax cuts. Did Keynes have anything to say himself about what kind of stimulus is best?
Well, first of all, it was supposed to be temporary. I think we've misunderstood it over time, seeming that he just wanted big governments and he wanted big deficits. It was supposed to balance over the cycle, so that's an important lesson. And it was supposed to be something that contributes to your long-run gains. So if we look back in the Canadian context, we have a home renovation credit that just got introduced, and the three of the examples they gave is to resod your lawn, fix your driveway, and fix your fence. And I go, excuse me, that's going to make the standard of living in the country higher? In the plan in the United States, there's a massive amount of capital expenditure for schools that got tinkered around a little bit in the final reconciliation, but a whole bunch of those school districts are where they're not even using fully the schools that they've already got, and they were fairly new to start with. So we have to be really careful. In theory, even if it makes sense, in practice it's difficult. You want to accelerate the infrastructure. First of all, you never accelerate it as quickly as you think. It always takes time for environmental assessments, cost sharing. It usually kicks in when the economy is already recovering. I think in the United States, we go back to the starting conditions. He wasn't advocating permanent deficits. The US already had a structural deficit. I don't think they have the right to be entertaining the thought of more permanent tax cuts. They're just piling onto that structural deficit. And yet the temporary tax cuts don't work. So when you actually get down to a practical basis, there's not that many instruments that really fit the medicine.
Tim, you want to react to smart stimulus versus dumb stimulus?
I don't think Keynes.
Go ahead.
Go ahead.
Go ahead.
Tim, then Jeff.
Well, I think that's a great point. There's something really broken in Washington, D.C. at least, and that's whether you have a Republicans in power or Democrats in power, they're pretty bad deficits. And I think Brad would say, but look at Clinton. I'll agree. I mean, I'm not here as a partisan, but I think fundamentally there's this notion that they can run deficits without consequence. And because America's an exceptional country and money from abroad's been coming in to fund our deficits, we think so. But I think even the crisis we're in now is nothing compared to how bad it would be if we didn't have low interest rates, thanks to the rest of the world pushing their cash here.
Jeff?
Yeah, this deficit is not being taken on willy-nilly, superficially, just for fun, for the Democrats to spread their pork around. This is a really severe, this is an economic emergency. It's far more than a crisis. We need this deficit right now. So I don't think it's right to characterize Washington as being irresponsible for pushing these deficits. That's a way of thinking that I think actually was applied in some historical cases, but not in many, and has been overused. This is a serious emergency. We need money out there. And I also want to say that I doubt Keynes would have been upset about spending money on public investment in this period. And unfortunately, somebody did give me a reference to Keynes later in life who talked about the value of using, you guys may not believe me, and I've lost this reference. He actually talked about the value of public investment because you get a double hit. You get the stimulus, and you build the assets the nation needs. The fact is, we have let the assets the nation need be neglected, in my view, for 30 years now. It's not an accident the civil society of engineers grades as D for dog, not B for boy, D for dog on the quality of infrastructure. Now, do we have to do this carefully and intelligently and prove that a government can do this right? And I think most important, coordinate it. Coordinate energy, transportation, housing issues, yes. But
Sure.
To dismiss it willy-nilly is wrong.
Okay, let me read a piece here from Commentaries, March 2009 magazine. James K. Glassman wrote this. Brad, I'll get you to comment on it after I finish reading it. Rather than getting jazzed up, we need to be calmed down and to take the time to learn from the Great Depression, a time when government did too much, not too little. Amity Shlaes makes the argument in The Forgotten Man, her book about the Great Depression, that the constant experimenting and meddling of the New Deal froze investors and business operators in fear. Businesses decided to wait Roosevelt out, hold on to their cash, and invest in future years. Is it possible then, Brad, that all these overlapping government plans are going to create more rather than less uncertainty going forward?
I make 3 points. The first is this is James Dow 36,000 to Glassman. This is James Glassman, who in 1998 was telling everyone they had 3 to 5 years to invest in the stock market to triple their money as the Dow went from 12,000 to 36,000. This is not someone who has any business at all being in the public debate, at least not until he apologizes to everyone who read his book, returns his royalties to his victims, moves to the Amazon, and takes up a life of anonymous service to others.
I'm going to put you down as undecided, okay?
Part. Second, New Deal meddling. Yes, right, Roosevelt tried everything he could possibly think of, and some things that nobody had ever thought of, and then tried to reinforce success. The result is there's a huge amount of spinning wheels and wasted effort and counterproductive, mistaken stuff in the Great Depression. the worst of which I think is the National Industrial Recovery Act of 1933-34, fortunately declared unconstitutional by the Supreme Court. But Amity Shlaes's claim that it was Roosevelt who made businesses decide not to invest is innumerate at best. That is, businesses had stopped investing in 1932. There was no way businessmen could become any more scared than they were during Hoover's last year. And in fact, Roosevelt's first year, the year that sees the US go off the gold standard and adopt policies of monetary expansion, sees a significant recovery of business investment. That I don't know whether it's that she just can't count or hasn't bothered to count or thinks it sounds nice when she claims that investment didn't collapse until after Roosevelt took office, but it's simply not true at all.
Brad, seriously, you got to get off the fence, okay?
No, that's
I'm being facetious.
May I add I would regard myself as more as someone who thought Milton Friedman was more right than John Maynard Keynes on economic policy in normal times. And yet we have these really weird arguments out here.
Okay, Don Drummond wants to get in. Hang on a second.
Fast forward to 2009, a practical example of where the policy uncertainty erects a cost. I think everybody would agree we cannot get a meaningful recovery in the U.S. economy until we get the toxic assets out of the balance sheets of the banks. No one wants to do any interbank loaning. They can't do it. The difficulty is there's no market price. Why is there no market price on that? Is because banks don't want to sell it into the private market because they think the government will come and bail them out. Private investors don't want to buy it because they think the government will bail it out, and everybody just sits on their hands.
Paralysis.
So the treasurer comes, and on Tuesday, he's going to give the solution to this thing. What did we learn? We learned nothing. And so it has been paralysis. The market has been frozen. The market would create a solution, albeit a painful exclusion. There'd be lots of haircuts all over the place, but the market would sort that out if the government allowed it. So you got two choices. You either got to come in and say you're going to buy it up and at what price you're going to buy it up, create some certainty, or you got to say I'm hands off. You sort it out in the market, but you don't get either one, and you get the paralysis.
I want to bring another chart up here, and then Jeff, I'll go to you first on this. We're calling this one Uncle Sam and Recessions. This is U.S. government spending increases during recessions as a percentage of GDP, and we've gone back over the last couple of recessions. 1980, government primed the pump to somewhere between 1% and 2%. 81, 82, the recession then just over 2%. The early 1990s, less than 1% of GDP. In 2001, again, less than 1% of GDP. The 2007 dash, we don't know where it ends yet, that bar on the graph is off the charts here. Well, it's almost off the charts. We're up over 6% of GDP at the moment in terms of U.S. government spending increases during the recession. Even if we agree, Jeff, that Keynesian-style stimulus is warranted, what are the chances here that you guys are overdoing it?
I don't think the chances are high. In fact, the chances are probably higher that we're not doing enough. I'm not in the camp that says we definitely have to do much more, but I think the odds are we should be doing more. We started with the big deficit. We started with the Bush deficit. I think the good news is we had those deficits in the past that helped us get out of the economic rut. But I think the numbers are very clear, and I go back to what I said. We have this rush out of the markets for goods and services by consumers that could get very severe. And when they get severe, then they get more severe in the next round, and still more severe in the round after that. And we have to create the floor. I don't think the issue is let's look at the size of the budget deficit right now. I think we're facing such steep risks in this economy, and they're compounded by what Don brings up. Because the real leak in that boat, the real leak in the toxic asset boat is the ongoing defaults. Nobody knows the value of those mortgage obligations. I disagree with them a little bit about waiting for government. Nobody knows the value of those mortgage obligations because the defaults keep going on and the house prices keep falling, which means more defaults. If we have a recession and even less income, we'll have still more defaults into the future, and we'll begin to get defaults on all kinds of other assets, not only consumer assets, but corporate assets. I've got to emphasize what a serious crisis this is. And there are no easy ways out, but this is the way out. This is the way of least harm, and creates the best prospects for growth after that.
Okay, let me put this to Tim, though. I mean, there are not many, but there are some voices out there that are raising the red flag for what the ever-increasing amounts of future indebtedness made due to your country and you know, the Western world at the same time. What's the status of those voices today?
Well, frustrated. I think also where I disagree with Jeff is on two levels. One, the real problem is not that aggregate demand's fallen off for some crazy reason. This is a symptom. And so you can't just reinflate lost consumption spending with government spending. It's the wrong kind of spending, for one. But two, it's a symptom of a bigger problem. It's the banking system. And that's really where the fix needs to happen. The second thing is this notion that things will unravel and unravel and unravel. I believe, and I think the long run trend shows, the economy grows. As long as the government doesn't mess things up too badly, I think we could say this is an episode of the SEC maybe not regulating effectively. At Great Depression, I think we'd all agree that monetary policy moved in the wrong direction a couple of times, to Brad's point. But we're going to recover from this, and I think people need to just calm down and not lose their heads and think a little bit longer term. Let's not make the financial system dramatically worse and have interest rates suddenly spike up because the world thinks, you know what, look at what happened in California. If it can happen there, if you have basically the government shutting down, not giving people their money they're rightfully owed with tax refunds, if the DMV is not open, I mean, I worry about Brad's job. He works for the California government. If they see that happening and they start to worry about the federal level, you know, can we rely on these T-bills? That's a really scary question to ask.
We did that same thing in this province 15 years ago. Everybody thought the premier of the day, Bob Rae, was nuts. He ended up losing the next election, but now 15 years later, Arnold Schwarzenegger's trying the same thing. Parenthetically, he says, for whatever that's worth. Brad, let me read something and get you to comment on it. This is Jeffrey Sachs in the Financial Times from a couple of months ago, where he writes, there are many valuable things proposed in President Barack Obama's spending, but these should be incorporated into medium-term strategies rather than a grab bag of hasty short-run spending. The tax cuts that he is likely to approve in the stimulus package could close the door to these longer-term programs. Haphazard spending on these vital programs could do the same. Everybody, obviously, that's the end of the quote, Brad, everybody obviously is paying great heed to the short-term, immediate issues that are before you. However, is enough attention being paid to the medium and long-term on this issue?
I would say probably not, and I would say probably not because Barack Obama has tried to govern, well, wants to govern, has tried to govern in a post-partisan manner. So that when he came out with his proposal paid a bunch of attention to Democratic spending priorities and a bunch of attention to Republican tax cut priorities, in addition to a bunch of attention to the stimulus priorities. And so as a result, as far as stimulus goes, it wasn't all that terribly well crafted. But the idea is you come out with something that everyone has a good reason to say yes to, and you can move it through very quickly. You can move it through by, in fact, the time of the inauguration in order to get the money into the system as fast as possible to make the recession as short as possible. Now, that didn't happen, right? That even though the bill starts out at kind of 35% Republican tax cuts, the Republicans say ew, and then Senators Specter, Snow, and Collins, who are actually willing to break party discipline and vote to cut off debate on the stimulus package. They agree to do so only if a bunch of random changes are made to it that make it much less effective as an actual stimulus. Things like the alternative minimum tax fix, which has little effect on what people are going to spend over the next year, but which is a cause very dear to the hearts of the upper middle class people who are the principal contributors to American political campaigns. So I would say that Jeff is by and large right, that Barack Obama could have come forward with a significantly better stimulus package and could have saved longer-term priorities for other vehicles, but that it was his attempt to create an era of good feeling, a political gamble on his part to try to get people to move beyond partisanship. That's the course of the policy problem.
But Brad, was it bipartisan in the House when even some centrist Democrats said this bill's too liberal, we're not going to vote for it?
No, I mean, Barack Obama comes out with 35% tax cuts instead of the 0 that Nancy Pelosi wanted, and gets not a single Republican vote in the House and only 3 in the Senate.
You can't say that only Republicans believe in tax cuts,
after a whole bunch of the good stuff for the state is carved out.
Okay, hang on. Tim, let's hear you on this again.
Yeah, I think it's really shallow to say that only Republicans are for tax cuts, because there are a lot of Democrats that are in favor of some smart tax cuts. That are the payroll tax cut's a big part of this plan. You can't say that's a big Republican thing, because it goes towards the poor working Americans. So
okay, so I'm glad to hear it said that Republicans are not for things that benefit the poor and the middle class. That's a good thing to have out on the table.
The fact that even centrist Democrats wouldn't vote for the bill in the House because it was too liberal, I think really speaks against, no matter how much Barack Obama wants to be post-partisan, I don't think Nancy Pelosi and the House leadership is ready.
You know, I don't understand this, but I have a hard time with post-partisanship and bipartisanship. You can't judge the quality of a bill by how many Republicans or centrist Democrats or Democrats voted for it. It seems to me there are lots of political considerations on the part of Republicans. They don't want to give Obama a victory. I think he made a mistake, and probably this is what Brad's alluding to, in coming up with $300 billion in tax cuts to begin with. He should have started with a much lower number, and if we got to the current number, people would be saying it was more bipartisan. We shouldn't take this notion quite this literally. But can I make one comment about something Tim said
Briefly, if you
before?
would, because we're down to our last few minutes here.
Very quickly, and it refers to Amity Shlaes as well. We look back in history at things like the Depression, and we got out of it, okay? But I don't think we ever fully remember the pain involved, or the fear involved. You know, the economy was going down lots before Roosevelt took office, and people kept saying, don't worry, economies bounce back, don't be too afraid, be confident, so forth and so on, much like John McCain said, that the economy is fundamentally strong. I think that's really the dangerous situation, and frankly, Tim, it becomes a fairly catalyst situation, because this unemployment rate can soar, and the unemployment rate really won't measure the full extent of the pain, and it has become an issue separate. The credit crisis is part of it and has to be solved simultaneously, as does the housing market problem, but this recession has taken on a life of its own, and we know historically when it takes on a life of its own, it can get very bad.
Okay, Don Drummond, let me, with just a few minutes left, put one more thing on the table here. John Maynard Keynes, of course, lived and died before the emergence of what we now consider to be a deeply interconnected, highly globalized economic system that we have today. So how relevant would you say his theories, which go back quite some time, decades, are in an era when the economy is so different?
Well, I think that cuts two ways. A lot of his recommendations, if you believe them, have to be applied to multiple governments together, and more or less we are seeing that. Interestingly, we had this theory of decoupling. The rest of the world was going to blast through growth while the U.S. suffered. Obviously, that didn't shake out too well. So we are seeing that kind of coordinated response. But even in that interconnected world, the U.S. consumer is still pretty much king, and it was the U.S. weakness that really toppled the rest of the economies before. But I'll say one thing on the interconnected. In Canada, we study the United States, but I would suggest the United States should study Canada. We've been where they're going, and it's not very pretty. I mean, these numbers will sound familiar. They're going to end up with a structural deficit, 6 to 8%, a total government sector debt of 100%. Those were our numbers, and they're not going to get back out of it. And I would argue, actually, their political makeup makes it more difficult to get out of it, because they have so many checks and balances. They give such a weight to minority interests that they can't do what Canada and some other countries did while they were operating in a democracy that had strong majorities, and they suppressed that minority view. So that's fine to do this stimulus in the name of temporary. It won't be temporary. They create those huge deficits, and I don't see a ready mechanism back out of the hole.
For those who don't know, we should remind them, you were Assistant Deputy Minister?
Well, I was Associate Deputy Minister, and we did. When we brought...
So Paul Martin, when he was the finance
we
minister.
cut the level of program, not the growth rate, we cut the level of program spending by 12% over a 2-year time period. No other country in the post-war has done that, but it was done out of a government that had a very strong majority, and without a lot of those checks and balances, and people kicked and screamed, but their voices didn't amount to an awful lot, not like the U.S.
Tim, let me give you okay, Brad, go ahead, quickly.
But the financial markets don't believe you. That is, there definitely are situations in which you need to worry an awful lot about the run-up of government debt.
Is this one of them?
But those are all situations in which the long-term interest rates on government debt are rising rapidly. If the case were that as the stimulus bill was moving through Congress, you were seeing the long-term interest rate on U.S. Treasury bonds spike up to previously unseen levels, then I would say that that's definitely a point. But it's at the very least premature to worry about exhausting the debt capacity of the U.S. government if long-term Treasury interest rates continue to stay astonishingly, extraordinarily low and quiescent, as they have been doing so far.
Brad, you'll have to forgive me. The one thing that's not premature is the clock. It says we're out of time. Brad DeLong, Tim Kaine, Jeff Madrick, thanks so much for being there for us. On the line from Points Beyond in the United States, Don Drummond here in our studio in Toronto.